I made a lot of losses during my first year of trading. I was a beginner. I used to think that trading is all about applying proper risk management, ICT, smart money concept, etc. Trading is about using the right strategy at the right time. After using the right strategy at the right time, you need to have the right psychology at that given time. Avoid doing things that will affect your psychology, because the moment you damage your psychology, your trades are no longer going to be accurate. That is why you see people making $100 to 300. Then after that, you will flip that $300 to $50. At the end of the day, you will get frustrated. So in this video, I'm going to show you the mistakes I made so that you avoid them by all means and maximize your profits. If you are new to this channel, make sure you like this video and subscribe to our channel. I also give free lessons. If you want to learn how to trade for free, just join our group using the link that is in the description. It will direct you to our Telegram channel. Here is how I lost most of my funds in my first year of trading. As a beginner trader, there are certain things that can happen. You might think that you have mastered the whole thing, but you haven't mastered it yet. It's all about consistency. It's not about trying to flip an account. It's not about growing an account from 100 to 1,000 or 100 to 5,000. It's about being consistent. Because the moment you grow an account from 100 to 500, your psychology will be biased. You now think that you control the markets. But if you trade with that kind of a psychology, you're most likely to end up blowing that account and it will frustrate you. As a beginner trader, I have been applying a lot of concepts. For instance, in my first year, I was using a lot of concept, trying to use price action, trying to use smart money concept, BTMM, etc. So you can use all of those things, but as long as you do not have the right psychology towards trading, you're most likely to blow that account, because most people, they know how to trade, but they don't know how to take profit and secure the bag. So I'm going to be showing you the mistakes I made in my first year that costed me a lot. So you should watch this video until the end. So basically, what you should do is, most people can analyze the market on M1 or M5. Some analyze on M15, but I'm going to focus more on the mistakes I made as a beginner trader, and I'm going to show you whatever I was doing during that certain period. So as a beginner trader in my first year, this is how I was trading, guys. So I'm going to show you the first mistake I made as a beginner trader. The first thing is, I was analyzing my market on what? On 1 minute time frame. So I'm going to show you what I was doing. So this is our 1 minute time frame. As you can see, there is the 1 minute time frame. So what I would do, I would draw my trend lines on this 1 minute time frame, thinking that I can catch spikes. Guys, if you draw trend lines on 1 minute time frame, you are most likely to get liquidated, and the market will crush you, guys, and you end up thinking that you're not a good trader. So this is what I was doing. So I would go on M1, then I would draw my equidistance channel. So I'm going to draw it here, and I want to show you exactly what happens, guys. Right. So basically, this is what I would do when I go on 1 minute time frame. Then I would say my TP is this previous high. So I'm going to highlight that previous high point, which is this one. This is what I was doing, right? Something like this. And I would say this is a very good setup. So you can see here with a breakout here, right? Then it just spiked twice, right? Then after that, it pulled back. So according to the books, they say when the market breaks out, you wait for a retest. So this is the retest. After the retest, you enter and enjoy that movement. So what I would do is, I would enter my buy entries here, then enjoy this upward movement, but I would not close this profit. That's the first mistake you can make as a beginner trader. If you fail to close profit, what are you going to close? A loss. Because check what happened next. Here, before closing your profit here, what is going to happen? The market is going to start reversing. Then it will start giving you these small spikes, thinking that it's going to what? It's going to give you more spikes going up. But the thing you should note, as long as you see that the market price just crossed the spike that just happened, just know that it's now time to take profit. Always hold trades that are giving you the right confidence for you to continue holding that trade. How do you know that a trade is still going up? It should give you spikes that does not cross where the previous spike happened. For instance, here we can see that we have something like this. Here spikes were going up, right? Spikes were going up. As long as the market price crosses this previous spike, just know that it's now time to take profit. Even if it's less, guys, it's better to take less profit than to take a loss, because look what happened later. Just because I wanted the market price to reach this previous high, it ended up going down this further, and you end up blowing that account. After blowing the account, what happens? Your psychology is damaged, but the strategy was okay. So you see, it's all about the psychology. It's not about the strategy only, but it's about using the right strategy and the psychology. So I would end up getting frustrated because of this, right? After that, we also have another scenario whereby people will end up adding funds or adding positions. I used to do the same. I would say, let's say the market is spiked like this. Then after this small spike, I would add positions. Guys, this is very risky. Adding positions when a trade is in profit is very risky, because when the market starts reversing, you end up thinking that the trade is no longer going your way, and after that your psychology is damaged. As long as your psychology is damaged, avoid holding that trade. So you see, let's say you've entered your buy entries here, then the market starts to go up like this, then you add a position here. Because of this small pullback, you might close that trade because you think it's now going down. So basically, when you enter a trade, usually try to enter your trades here and avoid adding positions. If you have analyzed your market on M1, avoid overholding that trade, because you are basing with the 1 minute time frame. So as for me, I would hold that trade thinking that the market is going to continue going up, and it would cost me a lot of money. So here I have shown you what happens. Avoid overholding the trade, avoid analyzing the market on M1. In the event that you want to analyze the market on 1 minute time frame, just to know that you are scalping, and avoid letting a trade that once made profit go back to loss. It will affect your psychology, and your whole day will be damaged, and you might end up not trusting your strategy. The other thing I did, I was using a lot of strategies, guys. I would use the trend breakout, I would use the pin bars, I would use a lot of things. Yes, you are getting more confirmations is better, but avoid overusing those techniques, guys. As long as you are now confused with your concept, it will become hard for you to know what is really happening. For instance, we can say we have this one, we have a trend breakout, then this is the retest. This is another strategy that you can use to enter the market. Here it went up. Then we can now say, if we go to H1, we can see something different from this. Then we can now say, the market is now what? Is now giving us, let's see, the market has given us an engulfing bar here. Then we can say this is an engulfing bar of a bullish movement. Now the market is now going down. So you see, these kind of things will confuse you. So the easiest way to trade without a lot of stress is to analyze the market on a bigger time frame. Because if you analyze the market on a bigger time frame, you have a high chance of holding your trade for long, and you have a high chance of making more profit, right? So if you analyze the market on a bigger time frame, you are not going to enter that trade full margin. I would do the same thing. Here we have what? We have a order block, guys. As you can see, this is an order block. I would fund my $500, then say this is an order block. But the mistake I would make is this. Let's say this is an order block. This is H1. So H1, it will be giving you hourly candlesticks. So even if you enter here, even if you enter here on this week, you place your entries. Let me draw a horizontal line. I want to show you what will be happening on the 1 minute time frame. This is the horizontal line, right? Let's say we've placed our buy entries on this horizontal line. Then I go in full margin saying the market should go up. Always the market should go up. I want to go in full margin. Let me show you what happens when you go to 1 minute time frame. Right. Let me try to do this. Right. So this is our 1 minute time frame, guys. As you can see, the moment you go in full margin here, you can see that there's a time that it will go down a bit before it goes up. So in the event that you have entered your trade full margin, for instance, if you had entered your trade here, basing with this order block, if you had entered your trade here, this is the right trade, but just because you have entered full margin, what is going to happen? It will liquidate you here. Then you end up closing that trade thinking that it's no longer going to go up. Then just after closing, it will start spiking like this. Then after 30 minutes, you check the market and see that it has moved like this. Then you now say, maybe I entered too early, maybe. No, it's just that you entered full margin. It did not give the market some time to breathe. Whenever you are entering a trade, guys, it is not a get rich quick thing, guys. We are not here to flip 100 to million. We are here to secure the bag. So the best way to do it is always apply proper risk management. And when I say applying proper risk management, I'm not just saying you're just using a small lot size. No, it's a matter of knowing the type of risk that is surrounded by that entry zone. For instance, here we have this order block, then we have this order block. So in the event that we want to risk, we have to know that we have to distribute our risk around this zone, which means we are going to enter bit by bit until it reaches this zone. Then the moment it starts to go up, we are no longer placing any position. We are just holding our trade. Imagine holding a trade from here to here. You make a lot of money uh, compared to the one that entered full margin and managed to catch one spike and go off the market. So that's the thing you should do. Avoid those things by all means, guys. Avoid entering full margin. Avoid over trusting a strategy, guys. It's not a matter of over trusting a strategy, but it's about knowing that each and every trade you are entering, any of you is going to make profit, either the broker or you. So you have to have the right psychology. The moment you feel like the market is reversing, exit that trade immediately, especially if you're in profit. Exit that trade immediately. It's better to close a small profit than to close a bigger profit, because the moment you make loss or close a trade in loss, your psychology is damaged. And another thing I would do, I would say after closing a loss, I would say, maybe it was just a mistake. Let me fund again. If you fund again immediately, you are now revenging. So you are now using emotions to trade. The moment you trade using emotions, what is going to happen? The broker will make it worse for you. You are going to enter wrong trades. You are going to be panicking. So the moment you feel like you have made a huge loss that has affected you a lot, you can just stay off the market. Then maybe try the following day. You fund your account, you backtest your strategy and see what has been happening lately. Then another thing I would do, let's say I spend the entire week analyzing the market, trading on breakouts like this. Let's say I have been trading on breakouts like this. Let's just draw this breakout. We have our channel here. Let's say the entire week I've been trading breakouts and it was working for me. Here it's spiking, going up. I would make profit, take profit, etc. Guys, the market does not move for a month or for so many days the same way. That's the thing you should analyze. The moment you see that your strategy is working, the breakout strategy is working, or in whichever strategy that you are using is working, before you place any trades, try by all means to backtest what has been happening during that day, because we see that each and every day the market resets, guys. The market resets, especially on World Trade. It resets at exactly around a minute to 11 p.m. After that, it will start to move the other way around. So you need to see how the market has been moving from that period to the period that you want to place your trades so that you can backtest everything and see what has been happening lately. Because if you just enter basing on the strategy that you have been using the day before, it can manipulate you. You have to know that the broker also wants to make money. So for us to be able to secure the bag, we need to be ahead and we need to have the right psychology. So here is how you'll be trading. Avoid trading against the trend. This is what I would do, guys. Let's say you have a market structure like this. I would say the market structure is going down, right? You can see it's clearly showing us that the market is going down. So what I would say is it has given us a small spike. So I would enter here and try to catch one or two spikes. But this is what will happen, guys. As long as you are trying to trade against the trend, what is going to happen? You can catch two spikes, then it will start to reverse against you. But when the market is reversing against you, whilst it is going to that direction, it will crush you harder. Unlike trading when the market is going to your direction. If you want to trade spikes, look for a zone where the market will be acting like this. It's actually better to trade a market like this whereby it's going to your direction. You can see here you can just draw a trend line and say when it touches the trend line, I'm entering my buy. When it touches the trend line, I'm entering my buy. When it touches a trend line, I'm opening a buy entry. You're most likely to enjoy more profits this way, unlike trying to catch spikes while the market is bearish. So you need to know how the market moves, guys. For instance, here we can say the market was moving like this. You need to know these patterns, guys. Usually we can say here we have a breakout. We can say here we have a breakout, right? Which means the market is most likely to continue going up. So you need to be careful whenever the market reaches a zone with what with resistance, it will always try to what to react around that zone. For instance, here the market reached this zone with a lot of resistance, and what happened? It started to try to go down. So this is what basically happens. You need to first look for a zone where most people were liquidated. Because as long as you haven't identified a zone where people were liquidated, your chances of making profit in that trade is very low. So you need to look for a zone where the market once made other traders get liquidated. So we are moving on to the next concept. Avoid trading with hope. There were days where I would trade with hope, saying, the market should feel pity for me. The market should feel pity for me. I've been holding this trade for 30 minutes, not yet in profit. The broker will feel pity for me soon and go back to profit. Guys, that doesn't work at all. The moment you start thinking that the broker should feel pity for you, that's the moment you should realize that that is the wrong trade at all. You should trade a trade that will give you more peace. You have to know that this trade is going up and it's going up so smooth. Avoid trading trades that will make you lose your mind because it will affect the psychology in you. Because as long as the psychology is wrong or the psychology is now damaged, your chances of making losses are now high. So here we want to move on to the current structure so that you can see what you're supposed to do. So here I'm going to shift to our current movement. So guys, this is our current movement as you can see, right? The market is showing us that the market is going down. We cannot try to enter buy entries here. Why? Because the current market structure we are seeing is a bearish, which means in the event that you want to trade this kind of a setup, you are now looking for selling opportunities. As long as the market is looking like this, avoid it. As long as it's trying to show you that it's about to go up like this, maybe it's showing you that it's about to go up like this, your chances of losing are very high because check let's say you had entered here, then it gives you these two spikes. What happens next? It drops hard like this. You will lose most of your money, guys, if you trade this way. So the best way is to trade according to the trend. Avoid analyzing the market on the lower time frame. Always analyze the market on the bigger time frame, because on bigger time frames you're most likely to see these reversals and the right confirmations. So basically that is what you're supposed to do. Avoid all of these mistakes I made so that you can become profitable earlier than me.